Some have speculated that President Trump started dropping bombs abroad to distract from political problems at home. But if that's the case, he may have accidentally made some of those domestic problems worse, such as affordability. Gas prices had been a rare bright spot in the affordability fight, falling for the most part since Trump took office. Right now, however, oil prices are trading above $72, up 8%. This is after analysts had predicted oil prices could jump as much as 10% and climb as high as $100 a barrel, depending on how things shape up. That would translate to higher prices at the pump for consumers like you. It's all because of the Strait of Hormuz on Iran's coast. It's a vital shipping lane that transports, roughly a fifth to a third of the world's oil. Iran warned vessels to avoid it and has struck at least 3 tankers near the strait amid its retaliatory strikes on Gulf states. Data from marine traffic and analyzed by the New York Times showed a 70% drop in commercial ship traffic through the strait late Saturday. Here you can see on the screen the flow of ships through the strait before the first strikes were reported in Tehran, and a significant drop in movement afterward. The United Arab Emirates also ordered its 2 key stock markets closed on Monday and Tuesday as the country reels from Iran's retaliatory strikes. Joining us now to discuss is Ron Insana, veteran financial journalist and publisher of The Message of the Markets on Substack. So, Ron, thanks so much for coming in.
Thank you.
What do you expect to happen to oil and gasoline prices in the next days or weeks?
Well, if you just do the simple math, based on the types of calculations people do when oil prices move, we've gone from a $2.85 national average right now. If we hold above $72 to $75, you're talking about jumping back above $3 to $3.50 a gallon. So again, as you were saying, that one bright spot in the affordability case it kind of is turned on its head. And it also then feeds into wholesale inflation and consumer inflation readings that the Federal Reserve will be dealing with. So amid expectations that the Fed might cut if inflation were to fall further, that gets dashed because the one area that was depressing inflation was gasoline prices, and at least for the foreseeable future until we get some resolution here, oil and gasoline both might remain elevated.
Can you explain a little bit about why it would affect the other things that people buy, the other things that go into the inflation measure?
Oh, sure. It's a pass-through for a lot of different, products. So if you're thinking about buying anything that's plastic, if you're thinking petrochemical prices go up based on, whatever portion of unused crude oil is put into other goods, then you have the prices go up across the board. And then just by itself, oil and gasoline figure into headline inflation. And so that pushes the overall number up. And again, constrains the Fed, which was hoping that inflation was going to come to its 2% target. This keeps it probably closer to 3%.
It's been interesting to watch the stock markets because these seismic news events that you would think would cause lurches, not really moving that much. What do you expect tomorrow?
Well, it looks like right now, anyway, Dow futures are down a little more than 500 points. That's a little more than 1%. That is a rather undersized reaction to the start of a war. But I think there are other factors at play as well that, the market's keeping an eye on. Strong earnings so far, decent economic growth, and until recently, at least inflation that appeared to be moving in the right direction. So it's kind of hard to tell at the moment because we don't have all the information we're going to get over the course of this war, as it were. And so the market can go either way. If it turns out to be something that's resolved rather quickly and the Iranians come back to the table, then stock prices could go up. If this drags on and you see more casualties and you see this spread across the region and become a much wider conflict, then you'd see a much more pronounced reaction in the stock market.
So explain to some of our viewers, we think of ourselves as an almost energy independent country. We're the world's largest producer of oil. Why is what is happening over there affecting our prices here?
So the oil market's a global market, and the prices are set at the margin. So if you take any supply, out of the equation, it tends to push up the price globally, whether it's here or whether it's Brent crude that trades in London. There is an international benchmark price for oil. And particularly, look, if 20% of the world's oil supply stops flowing, that has an immediate impact on prices. And so whether or not that's sustained is another question. But certainly with the types of disruptions we're seeing right now, the risks of oil tankers getting hit, by missiles or insurance rates going up to run tankers through.
Or oil fields, maybe? If
you go back to the very first Gulf War, as you recall, when Saddam Hussein left Kuwait, he burned the oil fields. But that didn't have a protracted impact on oil prices at the time. So again, you'd have to see a very persistent disruption in the supply of oil to maintain prices either here or higher than where they are.
Are there other goods that come through the Strait of Hormuz?
Yeah, there are.
Be affected?
But nothing, I think, really that figures into the equation in the way, we would think about, having shortages of certain, consumer goods in the United States. But yes, it's more than just oil. But I don't think that part would have as big of an impact on the U.S. economy as oil, natural gas, and then ultimately gasoline as well.
So what happens to our allies in the region if there are these big disruptions?
Well, I mean, they draw actually quite a bit of revenue from oil. So the price goes up on the one hand. That's good for their balance sheet. On the other hand, they can't sell it because they can't move it out of the Gulf and they can't get it through the Straits of Hormuz. So that becomes a problem for them. And again, all of this is going to depend on the duration of this, right? I mean, when you go back again to Operation Desert Storm, the first Gulf War, it was over in less than 48 days, something like that. And the markets ripped to the upside. Oil prices crashed. And we've had a number of other disruptions in the region that have had temporary influences on financial markets. The one thing that is interesting and I think hard for some people to understand is that geopolitical events tend to have only short-term effects on the U.S. stock market. Other things play into the equation a little bit more. The level of interest rates, the value of the dollar, corporate earnings, things like that have a much bigger impact, generally speaking, in the long run on stock prices than even wars. And you could look at every war going back to the turn of the last century, and believe it or not, stock prices generally go up during a war and not down.
I was going to ask real quickly. I mean, we often think of Dubai as becoming a bit of a financial hub globally in terms of what its investment is, and its stock market is now closed for 2 days. Do you have a sense of how disruptive that is? When we think of the stock markets in New York and London closing, it seems to be much more significant to the global market. But how does Dubai's relate?
Well, so the United States is more than 2/3 of the market value of the entire global stock market environment. So minuscule, when it comes to overall impact. Certainly it's the type of thing that makes people nervous. But from, a pure financial markets perspective, it's small. It may have an effect at the margin, but not enough to really disrupt activity over here.
Back in 2003, when the Iraq War started, the country was in a better place economically, and there wasn't as much financial stress being the focal point of politics right then and right there. Is this a different moment for us to launch an ambitious, potentially nation-building?
You can make that argument. So if you go back to 2003, we had the bursting of the internet bubble, we had 9/11, and we had the corporate scandals, and we had a 2-year bear market in stocks, where stock prices generally went lower for that entire period. When we launched that Iraq war, we were actually at the bottom of a stock market cycle, and so we turned higher. Here, we're closer to the top of a stock market cycle, and we have these concerns. We have concerns about the quality of private credit deals that are taking place, in financial markets, and we have concerns about an AI bubble. So we're in a different place than we were in 2003. So this could be one element that does add literally some fuel to the fire if there's going to be a bear market. But for now, the losses tonight are relatively well contained. We'll have to see how this plays out over time.
Ron and Sana, thank you for being with us.